Accounts receivable in the financial statements. On the income statement, the accounts receivable shows up as bad debt expense. And you'll remember that it's an operating expense, or also called a selling, general, and administrative expense, and it's an estimate. It's not the actual people you're writing off, it's an estimate trying to match the revenue with the expenses that result from that revenue, of which bad debts is one of them. On the balance sheet, there's two presentations for accounts receivable. It can be shown net, as it is for Walmart, or it can be shown accounts receivable net of the allowance for bad debt or doubtful accounts, as it is with Eli Lilly. So either one of these presentations is fine of the receivables. Again, remember those are current assets. The notes to the financial statement, here's Nike here. And notice that Nike, these are from the balance sheet, current assets, and it has to tell you what the accounts receivable consist of and also how much the allowance accounts are, and if there's other kinds. For Walmart, notice it defines what your receivables are, and it shows that they're kept at their carrying value net of a reserve or that allowance or that provision for bad debts. So receivables are shown at what we call their net realizable value, which is the receivable minus the allowance account or the reserve account or the provision account. Again, notice you have to say how large that reserve or that provision is, and it also has to tell you if there's other kinds of receivables. In Eli Lilly, here's our footnote on the other types of receivables that they have. Coca-Cola, from the balance sheet again, we can see what their current assets are. Notice it picked the presentation where on the balance sheet it shows the amount in the ending balances in the allowance account. And in the footnotes, Coca-Cola is nice because it shows that they keep them at their net realizable value, and it shows you the beginning balance in the allowance account and the ending balance in the allowance account, and how much the adjusting entry was and how much was written off. On the cash flow statement, accounts receivable shows up in the operating section, and notice it's the change in the accounts receivables as we try to reconcile accrual-based net income to cash from operations. Notice it's a subtraction here because the receivables increased, and if receivables increase, that means that your cash is tied up in receivables and is not available in cash. On Hewlett Packard, notice instead of calling it allowance for bad debts, or they call it a provision for bad debts. And on that provision in the cash flow statement, they show two things. One, they show the income statement piece, which is the non-cash expense, and they also show the change in the receivables account. And so that's how they show the impact on the cash flow statement. So again, your choice as to whether which way you want to show it. Next, we'll turn to the direct write-off method in the next video.